know that this is a casual webinar among the speakers and us. So feel free to turn on your camera, to show us who you are and to engage a bit more, right? So yeah, good afternoon, everyone. My name is Siting and I'm the community manager of Future Lab. And here we have our mentor, Nick Ibrahim, who is an executive director from Brockland Advisors. And we have one more speaker actually, but he'll be coming in really soon. All right. Okay, so thank you so much for attending this webinar today. The purpose of this webinar is actually to give you more guidance and advice on how to start fundraising for your startup, and as well as the do's and don'ts as a young entrepreneur when you want to look for investment, right? Okay, so we shall begin with maybe Nick can introduce yourself and a bit about your background and maybe some insights into your investment firm.
Sure. Yeah. So hi everyone. So my background is actually quite diverse. So I started out in strategy consulting, and part of the strategy consulting that I was doing involved general corporate strategy, but we were also working quite a bit on M&A. Mergers and acquisitions, IPOs, and actually the firm that I was working for, Ethos, we had a sister company called Ethos Capital, and that was one of the first few private equity funds in Malaysia. So that's sort of my first experience in investments. I later left Ethos to actually join the private equity industry. So I was working with a PE fund called Creador. I don't know if anyone has heard about that. So Creador is basically one of the big PE funds in Malaysia. They also invest outside of Malaysia, in Indonesia, in India, and in Singapore as well. After that, I was in the US for a bit. I was doing my MBA. And I was also working in New York for a Fortune 500 company. I was working for the CF team for them. And then I came back to Malaysia, and the last 6 years has been with a private equity fund called Equinas. So Equinas is a government-backed PE. They have let's say around about $1 billion in assets under management. So we are, I guess, later stage investors than venture capital, right? So if you can imagine, VCs will invest a lot in early stage companies. Private equity funds will invest typically in growth stage companies and a little bit more mature companies that has quite a couple of years of profitability in the business. So we were agnostic investors, right? So we invest across different sectors. I myself covered a lot on consumer retail. I covered technology, and I covered manufacturing as well, right? So after Equinas, so recently I've joined a platform called Brockland. So I'm currently co-heading the Southeast Asia office for Brockland. Now, Brockland itself is a multi-business line investment services firm, right? So we have 3 core business lines. The first is really an investment banking business where we do a lot of M&A advisory, capital raising, and so forth, right? The second business is what we call a multi-family office business. So the MFO business really, manages the wealth and assets of ultra high net worth individuals, and we have we're currently managing in an AUM of about $600 million US, and that is invested in a couple of asset classes, public equities, fixed income, venture capital funds, private equity funds, and so forth. The third business line is actually venture capital, right? So our VC fund, currently we're into our second fund. We have $50 million that we're managing in the first fund, about the same in the second fund. Now, the VC fund is predominantly early stage investment in technology companies, right? So we invest, typically in the seed and Series A stages. I mean, if you want, I can sort of talk a little bit about the funding life cycle, in the VC space. But really, this is, I guess, the very, very early stages of fundraising for a company. And the investment amounts normally is in the region of 500,000 US dollars to $1 million US dollars. Now, the first fund, Broadgate itself, was actually founded out of the Middle East, right? So the first fund had quite a bit of a concentration of investment in the Middle East, but the second fund, we're looking more at more allocation towards investment, outside of the Middle East. We've done 2 investments in Asia, and actually part of my role is really to try and help deal source for the VC fund in this region. Yeah, so that's a little bit about me.
All right, thank you so much, Nick. That was very descriptive. Thank you very much. Before that, I would like to encourage the participants to also put in your questions. If you have any questions for the speakers, feel free to type them in the chat box. However, if you're too shy to make it public, feel free to just personal message it to me, and I will bring it up at the end of the Q&A session. All right. So I just wanted to clear that up. All right, so let's begin with the second question. Could you maybe briefly introduce what are the stages of the startup funding journey, and which stage do you invest in?
Okay, so the typical investment life cycle for a startup, it's quite bumpy, right? So there's no, I guess, linear path. Whenever you're starting a company, obviously, depending in what space you're in, you might have very structured forms of financing, and you might have very informal forms of financing, right? So the typical story is that, you're either using the capital that you have, right? So your own capital, you're borrowing from family members, friends, and this is often the typical, I guess, startup capital that you utilize to launch your business. Now, in more high technology areas, you might be getting grants from different institutions, right? So you might get a grant from, let's say a Cradle Fund, or one of the government institutions like MITE, to develop a technology and really bring that technology into the commercial space, right? Now, your structured financing doesn't really happen until you get to what we call a seed stage, right? Now, at the seed stage, this is typically when institutional investors come in, right? And we're talking mostly venture capital funds, but more and more private equity funds, sovereign wealth funds, and other institutional capital are coming a lot earlier, into this stage. Now, to get to seed stage, typically you are already, you already have a viable product, right? You're going to market, you're generating, at least some form of revenue. You have the traction of a growth company, and that, I guess, growth aspect of your business is actually showing very, very strong traction, right? You're either growing the number of users by 2 times every quarter, growing your revenues by 2 times every quarter, or some similar metric like that, right? Now, I think what you will find is that, as you go through seed stage and the other rounds, and it's quite simple, right? So you have your seed, you have your Series A, B, C, D, and so forth, right? And really, when you look at different venture capital funds, they may say, I'm a seed investor, I'm a pre-seed investor, I'm a Series A investor, or post-A investor, right? Now, it's not directly relatable to the amount that they're actually going to invest in, right? So you would see seed stage investments as little as, you know, 25,000 US dollars, right? And you would see seed stage investments all the way up to 5 million US dollars, right? So just the label of what stage of funding it actually is doesn't really determine what quantum of you know, amount of value you know, that you're actually going to raise, or the valuation of your business, right? And you know, we can speak a little bit about valuation, you know, later on if that's interesting. Now for you know, I think I mentioned before the company that I'm the group that I'm with currently, our venture capital fund typically invests in seed and Series A. We do a couple of Series B investments. Now, it's really about the market that we're in and how confident we are in the market, right? So, you know, as I mentioned, the fund itself, it's domiciled in Abu Dhabi. We have a lot of strong institutional LPs who are invested in the fund. So because of that, when we actually invest in the Middle East, we will take a lead on that round, right? What that means is that typically in an investment round, you might have more than one investor come in, right? So you might have 2, 3, 4, you know, sometimes even 10 investors that are coming in, right? Now, for a startup, you're not going to be negotiating with all 10, right? So, you know, collectively, there is some sort of an agreement that one investor is actually going to take lead. They are going to, you know, set the terms, you know, they provide the base term sheet, and all the other investors that are coming on will basically follow on, along on that. So that's I guess what you call a lead investor in a particular round. So in the Middle East, we will take lead. Outside of the Middle East, for example, if we invest in Asia, we've done investments in, you know, Singapore, we will not take lead. So, you know, we'll work with other venture capital funds in the region. Yeah.
See, all right, that's great. So Nick, what do you think is the most important thing that early startups should look at when they secure funds? Do you have any advice on how to gain investors' traction in order to secure funding?
Okay, so I think you know, at the early stage of I guess your company, right? I think the most important thing is to have a very strong plan of where this company can go, right? So obviously, if you're doing a fundraising round at pre-seed, it's you know, it almost overwhelmingly needs to have a very compelling idea, right? And you need to have the ability to actually communicate this idea, right? Sometimes you have a lot of technology background, you know, founders that have very good, you know, products or services, but they don't have that ability to actually put everything together to communicate to the investors. This is our plan for the next 5 years. This is our, you know, go-to-market value proposition. This is our business model. This is how much we're going to be charging. This is our revenue model. All of that, I guess, is very important. Now, if you are at a stage where you're missing any aspect of being able to build that business plan or to communicate it, right? There are avenues that you can work with, you know, at the pre-seed stage. We have platforms like business accelerators, right? So these are, you know, these could be VC platforms. You know, these could be exclusively, you know, accelerators. This could be, you know, government-backed platforms, right? So you know, you have you know, government platforms like Magic in Malaysia that you can go to. You know, they have formal programs of you know, business coaching. You can get business plan development coaching. You can learn you know, how to actually prepare for a pitch session, right? You can actually attend pitch sessions where you actually pitch your idea to different investors that are going to give you very valuable feedback, you know, on how strong your overall business is, right? And this whole you know, I guess process is what's going to get you ready until time that it comes that you're going to be doing a lot more formal fundraising rounds with, the venture capitals, right? Because once you get to that VC fundraising round, I'm not going to lie, it's a big task for you to do, right? It's a lot of work that you need to put in, a lot of presentations that you need to do, a lot of answers that you need, a lot of questions that you need to answer. So sometimes it helps to have platforms to prepare you for that, right? And I think in Malaysia, in Singapore, you have a lot of good programs for that. I mean, I know founders that have attended programs where they've been sent to Silicon Valley, working with accelerators like YC. These are most definitely very, very good programs. If you have the opportunity to try and get into one of them. Yeah.
All right, thank you so much. All right, so we understand that last year it was crazy, right, with the COVID
Yeah.
and everything. So what are the hot industries that investors are looking into, especially after the pandemic, and how has it changed as compared to pre-pandemic?
Yeah. So I guess within the context of this topic, right? If we are talking about venture capital investment, typically we're talking about the technology startup space, right? So I think every part of this tech ecosystem has become a lot more important, right? Because of the pandemic, you will have, I guess, business services that are related to mobility. That's obviously becoming more important, right? For example, a lot of companies are changing the way that they work. We're doing a lot more video conferences. We're doing a lot more off office type of work. So any form of technologies that would facilitate I guess business mobility is most definitely going to be very, very important. You could argue that that phase has accelerated a lot, and perhaps if you're just starting a company now, it might be too late for you to get into that, right? But as you can imagine, what's happened with the pandemic is that because this is a global phenomenon, right? So it means that this pandemic is affecting every country the same way, at the same time. It means that that acceleration of digital technologies is happening in every country, right? So it's really a unique event in global history, right? You don't have a lot of occasions. I mean, aside from the global financial crisis, of course, but this is very specific to affecting every economy and every market in the same way, right? So what that has translated to is that all these digital technologies and the impetus for you to actually procure these digital technologies, it has allowed companies in this space to scale up much quicker, right? And for those companies that are purely concentrated in a particular country and are not taking advantage of scaling up across different markets, I think that's probably the biggest area of opportunity that they might miss out on, right? I mean, you look at all the big US tech companies, you look at all of the listings for the different specs. All of this is fueled by, I guess, the post-pandemic world, right? And I think there has been some disruption, right? Most definitely, fundraising itself was relatively disrupted in the first 2 years of the pandemic, right? What you would find is that venture capitals that have invested in companies like e-commerce in travel, right? That business pretty much wiped out during the pandemic, right? So to keep those kind of businesses afloat, they've had to allocate capital into those businesses, right? Which takes away capital from investing in other companies. But that stage, I think, is over, right? So capital allocation to the VC space is actually quite healthy, I think, at this point, right? So yeah, a lot of opportunity in the tech space.
All right. So with that, right, the following up question would be, what are some of the successful investments that you have made?
Like I mentioned, I think I've invested across different stages of businesses, right? So I've invested in quite a lot of brick and mortar companies, invested in mature tech companies. One investment that we made, some of you might be familiar with this name. We invested in a company called Exabytes. Exabytes is a web hosting and cloud services company. So basically, if you are building a new website and you need someone to host it, Exabytes is a well-known brand in Malaysia. So we made that investment a couple of years back when I was in Equinas. And we invested in it predominantly because we wanted to build a regional business, right? So right after we invested in Exabytes, we bought the largest web hosting company in Indonesia, and after that, Exabytes had a presence in Malaysia, Indonesia, Singapore. So that investment, I guess, is in an area what I would call mature tech. Right, so it's been around for a very long time. Everyone needs it. It's part of the technology infrastructure, and obviously, the cloud infrastructure that forms the basis of most software and tech companies that is around today, right? So that thesis, I think, is still relevant. That investment we haven't exited, or rather, Equinas hasn't exited yet. But really, that story of the founder. I don't know if you guys know of the story. You might want to read up on this. The founder of Exabytes is a guy called Chan, and Chan founded the company in 2001. Very similar story with a lot of tech founders. He quit his university, and he decided to start up this business because he saw the opportunity, and he built this business from that point all the way to becoming a regional business that was invested in private equity, right? And his path to fundraising, I think, is very interesting because he never got any institutional investors to come in the Exabytes group. What he did was he had a panel of mentors, industry mentors, who he looked up to, who he convinced to basically invest in his business, right? And these investors have sort of stayed with him all the way for, let's say, 16, 20 years, right? Up until the private equity investor came in, right? So it's not always a very as I mentioned, linear path, right? You don't always have to fundraise from one group and then go to venture capital, and then go to growth capital, and then go to PE. It doesn't always happen that way, right? At any point in time, if you have opportunities, to fundraise with, whether it's business angels, whether it's an accelerator, whether it's a venture capital, I mean, you should pursue that path, right? And you never know. I think one advice that I would give, especially in a lot of the investments that we've taken a look at before, with the startup space, it's very, very important for you to be able to be very, very stingy with your equity, right? So one of the biggest mistakes that we find in startups is that you give away too much equity, right? And often, giving away too much equity, by the time you reach let's say Series B, if you are already, diluted down to 20% of the company and you don't have control, and you have other investors that are invested in there that are not doing anything, it's not a good sign, right? And a lot of venture capitals will actually get put off by that situation, right? But it's, it's chicken and egg, simply because to be very stingy with your equity, you need to have a very, very good business. You need to be able to set a very high expectation for valuation. You need to be able to convince the venture capitals that that valuation is justified. And sort of when you go to that each funding stage, you're able to sort of maintain your control over the company, right? So I guess that's sort of one important thing. Did that answer your question?
Yeah, definitely it did. And it sort of segue to the next question. So from the experience of being an investor, right, what are the good traits and bad traits that you've seen in a startup and that, young entrepreneurs nowadays should take note of?
Okay. I mean, there's really there's a lot, right? Simply because it really depends on what space you're in, right? So there's a lot of good and bad traits that are very, very dependent on sort of what business you're actually running in, right? I mean, I'll give you one example, right? If you have a business that is you know, I guess the way that you market your products and services is very tailored to a particular group of people. Let's say it's race-based, right? Let's say your company, just because the way it's built, your marketing is very skewed towards the Malay community or the Chinese community, right? That's really limiting your I guess, ability to actually grow the business beyond that community itself, right? You might think that, hey, I'm very concentrated in one particular customer group, and that's good. But what happens is that sometimes your company and brand gets associated with that. And then once you are bigger and you decide that I need to grow my customer base to, the entire country, and hopefully after that, different regions, you're stuck, right? Because you've built this product and service very catered and tailored towards, a particular race. That's just one example, right? Or it could be like, I specialize in a particular gender, right? I'm only doing female products. I mean, that could be good. That could be something that you could scale up all the way, right? But sometimes also that might get siloed, and you might have an opportunity to actually build other customer groups beyond that specific gender, and you realize that you might get stuck, right? Or age group, right? You might be very, very catered towards the 20 to 30-year-olds, and you realize that the biggest spenders are 35, 40-year-olds, right? And you've built too much of a platform that isolates that particular age group. It becomes very, very difficult, right? Tech businesses is very unique to brick and mortar in the sense that for you to scale up, you in a way I guess need to be very, very flexible in how you actually build a business, right? We've invested in a lot of companies where after a couple of years in investing, a particular strategy that doesn't work out, and you really have to pivot the business to be able to kind of realize the value in that business. I'll give you an example. Equinas made an investment in a tech company called Tranglo. It's also another, I guess, mature tech company. They do basically airtime transfer. If you can imagine, a lot of the foreign workers, when they need to send money back to their hometown, instead of sending money, they'll send airtime, right? Because everyone uses a phone, right? That's one way that you can do that. So Tranglo was in this business. Now, that business required a lot of capital to actually scale up, and there was a certain level that you could scale up to. but there was an opportunity in getting to the I guess financing, consumer financing portion. And we actually ended up getting a money lending license, and with that, the value of that business to the eventual buyer when we exited the business was really that secondary part of the business that they recently launched, right? So you have to have that ability to sometimes pivot your business, and sometimes if you get too siloed into a particular area or customer group or whatnot, you might get stuck, and your business gets stuck and it stalls, and then you can't move on from there. Unfortunately, the way that this whole technology life cycle goes, it goes very, very fast. Sometimes when you set the platform for your different fundraising stages, if you delay too late in one particular fundraising stage, you might find that the interest from investors are going to be a lot more diluted at that point. I realize Kevin has come in. You might want to introduce him. So yeah.
Hi, Kevin.
Hello,
Welcome to the
everyone.
webinar.
Sorry about that. Some complications with the internet where I'm at, combined with a flight change that ended up pushing me into traveling today as opposed to otherwise. So it seems like one thing after another is has been prohibiting me from coming into this, but glad to be here. So I guess I'll give a little bit of brief background on myself so that people know who I am. Name Kevin Brockland. My background, so I'm the managing partner of Indelible Ventures. It's a new VC fund focused specifically on Malaysia, seed stage. My background is entirely in fund management. I've worked in global fund management for basically my entire career, collectively managing about $500 million of assets collectively over that time. Worked in 20 plus countries, have done a few hundred transactions over the course of my career, spread across a wide variety of industries. So fairly broad.
All right, thank you so much, Kevin. So actually, we were just discussing about what are the good and bad traits that as an investor you have seen in a startup. So Nick has given his opinion. Would you want to share yours?
Yeah, I'm going to guess that we may end up having some similarities, even though I didn't catch what he had to say. But I'll start with the bad and then move into the good. So I think some of the bad traits is going to be, depending upon what stage of development your company's at. So if you're in the really early stage, then it starts to come down to a lot more on the vision and the understanding of the market opportunity that you're tackling. And if you're not able to demonstrate that sort of domain expertise, then that's going to end up being a serious issue. To be honest with you, in very early stage, having the most amazing product is not always necessarily meaning that you're going to succeed. I think you can get a lot of examples in a variety of industries where good execution beat a better product. And so the one that ended up getting market dominance is not necessarily technically the best. So I think that comes down to really understanding what the problem statement is, because if you understand the market better, you're going to understand the proper go-to-market strategies that are going to be necessary in order to be successful. So I think in the very earliest stages, it's a very people-dependent process. But as you get further along in the development of the company, you start getting a little bit more process driven, understanding whether or not you've built in the proper feedback loops into the company in order to actually take on regular basis feedback from customers, from stakeholders, from competitors, from internal, from external. There's a number of ways in order to create these sort of feedback loops to where you can kind of start shortening down the cycles related to your decision making and be much more efficient with your operations, so that you know that the decisions that you're making are the correct decisions and not wasting money chasing after something, or going after a new feature development that may not necessarily be suitable for the market. So I think those are, I kind of rambled a little bit, but I think those are some of the kind of the highlights. When it comes to good, I think it really, it comes down to an early stage, and I'm going to guess that most people are more on the early stage side. It really comes down to people, and as you grow, you need to start building in those processes. In summary.
All right, thank you so much, Kevin. Also, just another reminder for the participants. So be sure to put in your questions in the chat box. If you're too shy, feel free to personally message it to me, and I'll definitely bring it up during the Q&A session later. All right. Okay, so because Nick has also given his thoughts on what were some of the successful investment that he has made. So maybe Kevin, you can also share yours.
It's all you from here, Kevin.
All right. Well, full disclosure, I am an investor. Indelible is an investor in Future Lab, so I'm going to throw that name out there as one that we see will be an extremely successful investment. I have to throw that onto the top of my list. As far as others, I mean, anyone that's been doing investing for long enough has a number of failures, has a number of ones where they wish they did them, but they said no because of whatever reasons. And if you're fortunate enough, you have a handful of ones that ended up turning out really, really excellent. And yeah, I mean, I have across the boards. As far as some of the phenomenal ones, there's an Indonesian company that's just now getting ready to raise. So from my entry point, they're about 40 times the initial valuation of where I entered at. So it's always nice to see. It's not one of those, rocket ship all of a sudden 1 year later it becomes a unicorn. Still waiting to see whether or not I get can capture that lightning in a bottle, as people say. But no, I mean, for the most part, I mean, there's a handful of cases, but I mean, the common thread amongst them, of the really successful ones that I've had, kind of go counterintuitive to what you envision of a successful founder. A lot of people assume that it's this sort of larger than life personality that is kind of like the WeWork guy. I can't even remember what his name is, but that's there's an image around that's what an entrepreneur is supposed to be. But at least the successful ones that I've had, it's always quite humble people that are just doing what they love and not necessarily as concerned about the monetary outcome, but just concerned about trying to build something because that's what their passion is.
All right, great. Maybe you could also give some insights to some early startups, like what makes them ready for an investment, and what advice would you give for them to gain investors' traction to secure funding?
Yeah, so I mean, what gives you the sign that you're ready for an investment? I think the first thing is that you have to understand what getting an investment means for your next steps. Because once you get onto kind of the venture capital pathway, you're gonna be on it for a while because it's generally not raise once and you're done. That's not the common way of it. And so you have to have that anticipation of what the pathway of your company is, and that starts getting into not just the vision of where your product's going, but where's your vision of, where's the growth of the company going? How much are you going to end up having to raise over time? I always tell people to have a very strong understanding of what the pathway on their valuation and what the pathway of the amount that they're going to have to raise is, because I have seen circumstances where companies have given up too much equity too early on, And when they start getting into like an A round or a B round, and I'm not sure if everyone is familiar with the round names, but we use alphabet letters in sequential order. But when you start getting into an A round and B round, is kind of some of those middle, they're still considered early stage. It's not considered growth. So you're still considered early stage at that point. And investors are going to want to see that the founding team within the company, basically within the company, that there's still majority share, generally speaking. And I've seen a lot of companies give up too much too early on because they didn't focus on what's the pathway. And when you lose track of that pathway, you'll actually make it harder on yourself to raise capital later on. Not impossible, because there's plenty of instances where things like this have happened. So I'm not saying like 100%. I'm just saying the more you have to explain why you don't fit into what the standard expectation is, the less you're talking about the business and the future prospects of the business when you're actually having a conversation with an investor. So I think, to summarize that point, you really want to understand what you're getting into in the long run. Now, when you do go out and look for an investor, you have to understand, because it is a long-term relationship, you have to make sure that you're comfortable with setting up that partnership, because you are going to be in business with that person for a very long time. Can you work together? Does the person add value besides just bringing capital to the table? Sometimes it's network, sometimes it's know-how, sometimes it's strategic. There's a lot of different varieties of type of value add that an investor can bring in. So it's a question mark of whether or not that investor is actually bringing in the value add that you need. So I think those are really the two main, and while my camera just switched for whatever reason. So those are really the two kind of highlights. The rest of it starts getting into, nitty gritty details, which are hard to generalize in regards to what your actual capital needs are, and whether or not you can actually justify to an investor the use of funds, etc.
All right. Oh, okay. So we have a question from Jake, right? So his question is, what's one or some things about fundraising that entrepreneurs are not generally aware of, or just isn't being talked about often? Maybe Nick, you can give your insights on this first.
Yeah, sure. That isn't talked about often. I think maybe one of the things that entrepreneurs might not be aware about is just how difficult fundraising is, right? I mean, it's almost a case where, and again, this is nothing off entrepreneurs, because there's not going to be a lot of books that talk about this, or there's no straight manual that you can go to on how to do this, right? And obviously, even if there was a manual, it's going to differ, based on the market that you're in. But I think one of the things that I think is a big surprise is how big of an effort fundraising is. Oftentimes, you're not talking to, let's say, 1, 2, or 3 venture capital firms. You might have to speak to 20, 30, 40 venture capital firms, right? And when some eventually make an investment, that entire process that you go through to get that money in your bank account is actually quite lengthy, right? There's legal processes, obviously with early stage companies, the amount of due diligence that VCs will actually do might be a lot less, but there still is quite a bit of due diligence, right? So there's interviews with management, there's quantitative metrics that you need to show to basically validate that your business is worth a certain amount, right? So all the work that actually goes into the fundraising process sometimes takes away the work that you would actually do in building the company, right? And I guess sometimes founders that might be a one-man show don't realize that this is a case until they actually start fundraising, right? And sometimes it kind of stops their overall progress, right? So they might be trending quite well in terms of picking up the number of users or number of subscribers to their platform, and then they start the fundraising process, and it takes them 3-4 months to gain that traction, and suddenly their business stops growing, right? So to have that balance, often maybe taking in another founder who's going to handle just that. And we see a lot of startups actually do that, have founders that are dedicated to capital raising, or what they call capital formation, right? That's probably something that I see. Yeah.
All right, thank you. Maybe we'll pass the floor to Kevin for this question.
I think what Nick just said is an extremely good point. I think that's definitely something to highlight. I think digging a little bit deeper into that, I think people don't have a strong of an understanding on how to actually structure a fundraising process in a means that can become much more efficient. I did a webinar a while back where I basically was saying it treated like an enterprise sales style process where you're prospecting leads and going through, because you are going to end up speaking to a good number of VCs. I think to continue on this point, but on separate segments of it, is that you'll be speaking to a lot of VCs, and a lot of them will say no. And it's not necessarily, I mean, some will say no because they don't believe in what you're doing. I can't sugarcoat it and say that's not possible. But there's a number of no's that will come because you don't fit in with the timing, or the timing's not right for that fund. They like you, but the timing's not right. Or they're in between funds, or they closing an investment period, or there's a lot of reasons why they may still really like you and say no. Maybe you're slightly too early stage, so they could come in later. So even if you get a no, still try and maintain relationships, because probably 90% of the time that you get a no, it's more of a not right now. And so if you are out there fundraising, I've had people react very badly to getting a no, which is understandable because there's a lot of emotions involved. It's basically like telling somebody that they have an ugly child when you say no to investing in their business. Sorry, maybe that's a bad analogy. But it is, there's a lot of emotions involved. But like, the people that handle it well, they continue to say, hey, well, we send out a company newsletter to keep people up to date, and it keeps those feelers out there. And an investor that does seed stage may also do Series A as well, or may end up growing their firm to do different stages of the process. So maintaining those relationships and always keeping it open, and that kind of pays dividends, not immediately, but in the long run. Because you may end up getting an introduction. It's a small community of people that are doing investments. So there's a lot of chit chat going in between people, referrals, etc. So focus on relationship building. Yeah, I think the thing that most people aren't talking about are that there's not enough information out there. VC is very opaque. So some of these sort of tactical steps to make fundraising easier, I think is where it is. There's tons of information on like lean startup, how to build the business, all of these sort of things. There's tons of people writing books about that kind of stuff now, but on the fundraising, not so much. And it's really the tactics end of it.
All right. So we have another question from Regina. She would like to ask, what is your opinion on solo entrepreneurship? Maybe Kevin, you can take the floor first.
So it's a tough one, because to be perfectly honest with you, as at Indelible Ventures, I'm a sole GP, so technically I'm a sole entrepreneur. So when I say negative comments about it, they all actually apply to myself personally as well. So I should throw that out there for full disclosure, so that there's no misinterpretation of how this comes out. But the sole entrepreneur is going to end up being viewed as slightly higher risk. Building a business is incredibly difficult. and it takes more than a single person. That being said, one person can build out an incredible team around them, because really what the aspect of founders start coming down to is the fact that in the early days, people aren't really making salary or good income off of it. You're doing it bootstrapping and pinching every single cent that you can in order to build out that business. And so, when you have a team that each have equity into it, it's understandable that they're putting in that sweat equity and so forth. But it's having that rounded balance of skills and so forth that is where the risk is. That being said, I mean, when you look at companies that have failed, a lot of failed companies have, if you trace back the impetus of them, they come down to like founder disagreements and so forth. I've had instances of having to like do maneuvers to kick a founder off the board because they stopped getting along with the rest of the other founders, and it's like these chaotic messes. So for all the risks of wanting a founding team, there's also a lot of risks of having founders, because it's being in a relationship, a working relationship with other people for a long period of time in very stressful situations. And sometimes it's good to have a shoulder to lean on. I tell most entrepreneurs what you're doing is incredibly difficult. And if you don't have it in your business partner, you need to have it somewhere within your social safety net of having someone to where you can vent that frustration and treat as your sort of psychologist. But yeah, to summarize, solo entrepreneurship is oftentimes seen as more risky. There's some VCs that say no straight off the bat to that.
All right, thank you so much, Kevin. How about you, Nick? What is your thoughts on this?
No, I completely agree with everything Kevin said. Maybe a couple of things that I would add. I think the definition of a founder, if you're going to take it at inception, I think it's not a problem at all, right? To have a single entrepreneur who's founding the business at inception, right? But really, if you look at a lot of businesses, when they give off the label founder, it's never founders that are at that point of inception, right? You can be a founder coming into the business, 6 months, a year, even 2 years after that business originally started, simply because what the founder team actually means is that you're the core team that's actually building the business to the point that you are commercializing the business, are really growing and really entering that institutional fundraising phase of your business, right? So if you're at a stage where you're a single entrepreneur that is developing a product, developing a technology, building that small pilot scale of your business, I think that's completely fine, right? But at some point, as Kevin sort of alluded to, one, it gets very lonely, trying to address problems on your own. And the thing is, you're going to have a lot of problems, a lot of roadblocks along the way that you're going to have to overcome. And if you're the only person that's going to be shouldering this responsibility, it's a really difficult path, right? You're putting in all of that effort, you're putting in all of that risk, you're handling all of that risk. And as Kevin mentioned, once you start talking to venture capital, they know that, and they've gone through enough investments to know that one person can't handle everything, right? I mean, Kevin himself is in, I guess, the fund management field, right, which is very different from a technology startup, right? He obviously has a lot of experience across multiple different functions, and he has the experience to basically handle it. When you're a startup founder, you might not have that exposure or business acumen, right? You might be a very strong product person. You might not know a lot of things. And if you are stuck there trying to build a business, trying to learn about accounting, trying to learn about HR, trying to learn about how to fundraise and deal with term sheets and all these other legal requirements, it's a big task, right? And my recommendation would be, don't do it on your own forever. Don't wait too long, either. When you go to these platforms like business accelerators, pitch programs, those are actually good opportunities to find other founders to your business, right? Try and find people that fit you, that complement you, that have, skill sets that you don't have, and you have to be very humble about how you assess your own strengths and capabilities. And I think at some point, open that up and find other founders to actually join your business. That's kind of my point of view or recommendation. Yeah.
All right, so we have one more question, who is very shy, so she PM'd me. So I'll just keep her anonymous. So her question is, how do you bounce back when a venture capitalist rejects you? Maybe Nick, what are your thoughts on this?
On mute, sorry. Don't be shy, because that's actually a very good question. Kevin mentioned this a little bit in one of the things that he said, which is first you have to sort of acknowledge that it's going to happen a lot, right? So be prepared that it's going to happen a lot. And oftentimes, it could be other factors than a problem with you or your business or your business model or whatever the case may be, right? So you have to take it with a grain of salt. And I think at the same time, really, when you are actually getting rejected by investors, that's actually the best time to ask for feedback. And really, I think some investors might say, I don't have the time for it. No, they're not going to say that. I think most investors are going to say, yeah, sure. Part of the reason why we're not looking at this is this so and so is a problem, right? It could be, you don't seem to have someone to balance your business, right? You're a tech guy, you're a product guy, no one's handling the business aspect of the company, until you find someone to sort of balance that out. Then we can look at you as an investment, right? So those are opportunities for very, very good feedback, right? Sometimes when they say, your financial projections are way off, the market that you're addressing is wrong, you might get those kind of feedback from one venture capital, but not the same feedback from another. But they are very good reference points for you to actually take an honest look at what are the shortcomings of your business, right? And when you have that mentality, like, I want to take this as feedback and I want to improve every time I go to the investor. I want to improve the story for every new investor that I speak to, and that's going to be very, very important. When you have that mindset, I think it makes it a lot easier getting rejected. And also know that all of those unicorns that you've seen, they've been rejected hundreds of times, right? And if you realize that it's a norm in the industry, then I think it's you're going to do fine. Yeah.
All right, so due to time constraint, I'll save the last question for Kevin, if that's okay. So Jake asked, in terms of equity and valuation, is there a right amount or even a benchmark? Some investors may be more price sensitive than others, and as founders, giving up too much equity doesn't seem like a smart thing to do. So how should founder go about thinking this?
Yeah, I think that's a good question. There's somewhat general rule of thumb of kind of the range of equity that you can anticipate. It's changing a little bit. Like historically, a lot of VC funds have had target ownership marks of, I want to make sure that I have this percent of a company. It's been shifting over time. This region has not quite caught up to what's happening in other parts of the world in regards to some what can be perceived as crazy valuations that are happening. Although there was the guy from Golden Gate that just called it irrational on, I think it was CNBC or something like that. But as far as what you're looking at, I mean, generally speaking, each round is probably going to be somewhere in the range of 10 to 20% of equity. So if you add that up over a seed round, A round, B round, C round, by the time you get past that, you've probably given up about half of the company or somewhere in that range. If you start getting too heavy too early on, then it's a little bit tough. But when you're at that early stage, the challenge is, you know, beautiful projection models, all these kinds of things, they're good to show and everyone's going to ask for them. But the challenge always comes down to, how can you justify a valuation when you're just getting started, when you just got your first sort of sales and all of this? And it's the area when it starts becoming a little bit more art than science, because it starts getting into, I mean, there's science involved, but it's the storytelling aspect of it, of making sure that you have a compelling story in regards to what the market opportunity is, the size of market opportunity, and filling in the pieces to where, you know, when you're at an early stage, I've never had a company hit their plan 100%, hit their budget 100%. Over the 3 years post-investment, have done everything exactly as we had said on that day zero. But it's the aspect of demonstrating the analytical process of coming up with a tactical plan and a strategy that when you start rolling all of that up, that starts developing the storyline where you can actually justify the valuations that you're talking about. Valuations, if you compared a company based in Malaysia versus a company in Indonesia, and all things exactly identical, the one in Indonesia is going to go at a higher valuation because there's more capital chasing deals currently. So I want to caution people not to see in Tech in Asia what happened in a neighboring market, because the dynamics of availability of capital are quite different. And so you can't necessarily benchmark your expectations relative to those. But I'm rambling a little bit. I think the point of it was to focus on, you know, within those ranges, 10 to 20% is what's considered normal. There are instances where if there's a hot company, you know, my target is generally within that range. 10% is probably what we anticipate, but we have several deals where we go below 10%. And so it's a matter of justifying the storyline of what the valuation is and what your use of funds is. Don't try and raise money for the sake of raising money. And sorry, I'm going to throw one more point in this, is that I see a lot of founders realizing that fundraising is hard, accept a deal from an investor that they would normally not accept a investment from, simply because money's coming in, so they just want to jump all over it. So yeah, I'm going to add that point in there just to make sure that you're aware of what you're getting into in the long run with every decision that you make.
All right, thank you so much, Kevin. So just one last question, right? Do you have any last advice for people in the webinar right now who want to get you to invest?
To get me to invest, reach out to me. Don't be shy. I try and respond quickly. Sometimes my email box gets cluttered, so don't feel shy about sending a follow-up either. If for whatever reason it is a no, do ask for feedback. I have no problem saying what the feedback is. I'm guilty of doing the generic response when I say the no, because it's habit, unfortunately. But I'm happy to have conversations on the details of the business. And again, no's are generally not right nows. But if you want to get me excited about it, I mean, what you have to demonstrate is that you have a passion about what you're doing, that you know the space, that you have a plan. We have a specific thesis centered around scaling businesses internationally. So we want to be able to see a company that has a plan in order to be multi-market, and a kind of the logic built out on what their go-to-market strategy is going to be in those subsequent markets. But reach out to me, Kevin at indelible.vc. Feel free to reach out.
All right, thank you so much, Kevin. How about you, Nick? Do you have any advice for people who want to get you to invest?
Yeah, same as Kevin. Reach out. I think it's like dating, I guess. Saying hi, is often the hardest part. But after that, even if the conversation doesn't go, to an investment, at the end of the day, it's really about growing your knowledge in the space as well, right? As I mentioned before, there's no real manual for how to do this, right? The way that you figure out how to do this is by speaking to people, right? So yeah, shoot me an email. I don't know whether Sitang, you're going to be sharing our emails. I'm happy if that's the case. And yeah, start a conversation.
All right, thank you so much. Okay, so just for the participants' information, right? So Nick and Kevin are actually Future Labs mentors. So as they say, don't be shy, approach them. They are very friendly people. Yeah, they're very kind and friendly people, and they'll be more than happy to guide you if you have any questions for your startup. Yeah, so don't be shy and book them for a mentoring session on Future Lab. Yeah. All right. Thank you so much. I guess that will be the end for our webinar today. Really thankful for Kevin and also Nick for attending this the webinar as speakers. We really appreciate that. Just to commemorate this moment, can we have everyone to turn on their camera so that we can take a really quick group photo before we close this session? Yep. So really hope everyone will turn on their camera. Don't be shy. All right, I'm seeing a few faces. That's great. Okay, so everyone ready? Amina, can you help me to take a photo? All right, thank you so much, Amina. All right, so
Do we want to give another? No? Okay.
Okay, all right. 1, 2, 3.
Okay, got it.
All right, thank you so much, Amina. All right. Thank you so much, everyone, for attending this webinar. This has been a great time with Nick and also Kevin. Yeah, so I guess that'll be the end of our session today. Have a good weekend, everybody. If there's any questions that you have for them, feel free to email me, let me know. And also don't be afraid to approach them on Future Lab. Yes. All right, thank you so much. See you. Have a good weekend, guys.
Take care. Bye.
Thank you all. Bye.
Bye.
Everyone.